Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week we bring you three things impacting credit markets that we think you should know about. And for what it's worth, we don't consider Jay Powell to be a dangerous man. Just saying. All right, let's get started. This week, our three things are: 1. Risks. With the reality of the Great Deceleration setting in, we canvass the street to see what risks could turn market sentiment. 2. Economic growth is being cut in half, but corporate earnings are expected to grow at double-digit rates? We would take the under. And 3. Consumer ABS performance offers great insight into the health of the U.S. consumer. We'll talk to our head of ABS research for his insights. All right, let's dig a bit deeper. So we've reached the fourth quarter, the time when market gremlins and goblins appear to wreak havoc with portfolio manager hard-earned gains. This particular fourth quarter seems fraught with risk, as line of sight through all that's in front of us, the pandemic, supply chain disruption, Fed tightening, debt ceiling drama, is more than a bit murky, while valuations of risk assets remain stretched. So we've kept our eyes open for emerging risks, big or small, likely or not very, that are out there lurking. We saw that Nouriel Roubini, yes, that Nouriel Roubini, Dr. Doom from the GFC days, is out warning, of course he's warning, of threats to markets in this extraordinary time. He's written an interesting and insightful piece in the Project Syndicate newsletter titled, "The Stagflation Threat is Real." He reasons that a particularly troublesome cocktail of persistently loose monetary, credit, and fiscal policies are overheating the economy at a time when supply-side shocks are holding back economic growth, leading to 1970s-style stagflation and eventually a severe debt crisis. He outlines a list of supply shocks leaning on growth, including deglobalization, rising protectionism, tighter immigration restrictions, aging demographics, the China-U.S. Cold War, climate change causing spikes in food prices, persistent pandemics, cyber warfare, and wealth inequality driving worker-favorable policies. Sure, some of these are decidedly idiosyncratic and situational, but taken together they add up to significant economic challenges over the medium term. Perhaps that's why the Fed's longer-term U.S. economic growth forecast is sub 2%, which of course is dramatically lower than where we've been lately. Why Europe's post-COVID growth rate is similarly mired in muck, and why China's growth rate is coming back to earth. Chillingly, Dr. Doom has rebranded himself Dr. Realist. And continuing with the theme, Bloomberg checked in with three market heavyweights, Cathie Wood, Mohamed El-Erian, and Scott Minerd. Similar structural issues and vulnerabilities came up. Ms. Wood worries, as we do, I would point out, about deflationary forces. She highlights 5: DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain. She notes that there is good deflation, which causes a boom in economic activity where the innovation is taking place. But she warns about bad deflation, where there is disintermediation and disruption, and that is, in her words, very disruptive to the traditional world order. Over the near term, she too worries about stagflation as businesses have trouble keeping up with consumer demand. Mr. El-Erian, now president of Queen's College, Cambridge, worries about inequality, which was exacerbated during COVID. The rich have gotten richer, while the poor have become more displaced in the workforce and the classroom. That will surely lean on aggregate demand and create culture wars, alienation, and marginalization. Who's Dr. Doom now? And finally, Mr. Minerd introduces a black swan into the mix, something that has always been towards the top of our own list, the vulnerability, he actually says sustainability, of the global payment system. He says we are extremely vulnerable to an attack, putting the probability of that happening at very high, well over 50%. Such an attack, Mr. Minard figures, would essentially bring the global financial system to its knees. No shortage of Dr. Dooms here. All right, on to our second thing, corporate earnings. Here I'm going to channel my best Peter Lynch and make sense of some of the simple things I observe. As background, here's where we start. Stimulus equal to 25% of nominal GDP was injected into the economy, enough to grow it 3 times faster than what it would have done on its own. So it should come as no surprise that corporate earnings in 2021, using the S&P 500 consensus forecast, are expected to grow 22% over 2019 levels. Meanwhile, demand has been so strong it has created disruption on the supply side of things and price inflation to end users. Now, stimulus is running off hard, taking us back to normal. And many economists have caught up to all of this by cutting in half their Q3 GDP forecasts from 6% to 3%. Yet S&P 500 EPS is forecast to grow another 14% in Q3 year over year, and 19% in Q4 year over year, and 9% full year 2022 over 2021. So in a nutshell, earnings are forecast to grow at very healthy levels, while economic growth is sagging. Does that make sense? Well, here's where my simple observations come into play. My local coffee shop is essentially out of food. They can't get deliveries. I can't buy what they can't sell. They now close at 3 p.m. because they cannot find enough workers. And many Manhattan restaurants are closed Monday and Tuesday because they cannot find enough workers. Consumer sentiment is decidedly moribund, impacted by pandemic fatigue and rising prices. And behaviorally, the consumer has already gone on a durable goods spending spree. It's not like he or she is looking to buy yet another car or home. So we're just not sure we see where all of the optimism supporting corporate earnings growth is coming from. Margin pressure is real, lost sales due to supply disruption is real, and the loss of stimulus, even if only a portion of that was spent, is going to leave a mark. Be prepared for weaker than expected corporate earnings over the near term. All right, on to our third thing, the health of the all-important U.S. consumer, whose consumption accounts for upwards of 70% of the economy. Now, we know the so-called twin bazookas of fiscal and monetary relief, extraordinary in their size and speed to the problem, more than filled the hole in the economy, driving U.S. GDP growth in 2021 towards 6%, or 3 times the normal rate of growth, according to the Fed. And that was highly instrumental in producing something, extremely low consumer loan losses, that few would have forecast in those darkest days early on in the pandemic. But all good things must come to an end, and for consumer lenders, that means the benefit of stimulus. And that means that the lending environment is going to change, be a bit more challenging in 2022. To help us gaze into that crystal ball is Brian Ford, who heads up asset-backed research for KBRA. Brian, welcome to the podcast.
Thanks for having me, Ben.
Brian, you've just written a piece on consumer ABS, just in time for the industry's conference in Las Vegas next week. What are consumer ABS showing in terms of the health of consumer borrowers?
Yeah, it's been a very solid 18 months of performance throughout the pandemic, which is somewhat counterintuitive. Typically, we see a consumer credit performance track unemployment very closely. However, over the last 18 months, we've seen delinquency rates fall compared to pre-pandemic levels, just as unemployment was skyrocketing to previously unimaginable rates. There's a couple things going on here. One, the US consumer was in a very good spot heading into 2020. Households have delevered significantly since the financial crisis. Going into 2008, households were leveraged 1.25 times debt to income. Going into 2020, that ratio had fallen to below 0.8 times. You've also seen debt service coverage ratios for US consumers fall to all-time lows as a function of the low interest rate environment that we've lived in over the last decade. So with the consumer on solid footing going into this pandemic, the added benefit of stimulus, loan forbearance and enhanced unemployment benefits really helped as a safety net to keep borrowers current on their debt service payments. And as a result, delinquencies are way down across all the consumer asset classes that we follow. And as a result of delinquencies being lower, we're also seeing lower loss rates or lower defaults on these underlying loans. We've also seen recovery rates in a lot of asset classes shoot up. For example, the used car market right now is extremely hot as prices are up around 30% compared to 2020. And so for those borrowers that do default, you're seeing very high recoveries on those loans.
That's great color, Brian. Thanks for that. We've noted on the podcast commentary from Rich Fairbank, CEO of Capital One, who said that the pandemic period is unique in that consumer loan losses, which are usually pulled forward in a downturn or shock, will be pushed out until the point where government support, in this case, pulls back. Now, you mentioned that you are somewhat uncertain of where credit performance is headed. I suppose we are, to some degree, in uncharted waters here. Brian, what are you expecting?
Yeah, I think that's right. Throughout this pandemic, you've seen borrowers be prudent with the extra stimulus checks that they've received. Over 1/3 of stimulus checks went to pay down debt, while about another third was used for savings, with the remaining third used for expenditures. So these extra stimulus checks have certainly been a benefit to consumer credit fundamentals. We've also seen servicers really work with borrowers in terms of extending loans or modifying loan payments to allow for a period of non-payment to help these borrowers bridge the gap during furlough or during the time that they're unemployed. A lot of those programs have ended for servicers, and with extra stimulus looking very unlikely and the roll-off of enhanced unemployment benefits in early September, we do expect performance to begin to normalize and weaken back to pre-pandemic levels, or potentially worse than pre-pandemic levels, just given that the labor markets are relatively weak compared to where we were going into 2020. That said, I think that the pace of any weakening in terms of consumer credit will be gradual. What you have seen, savings rates continue to be elevated throughout the last 18 months as borrowers have received enhanced unemployment as well as these stimulus checks. So certainly there is some excess savings that consumers do have currently that can be used to stay current on their debt. We've also seen credit card capacity or utilization declined around 15% over the last 18 months. Borrowers are using their credit cards less because they have more cash. So there's another potential way for borrowers to kind of smooth their debt service payments by starting to creep back up on their credit card debt to, pre-pandemic levels.
Thank you for that, Brian. Terrific color. So there you have it. 3 things in credit. 1, as we correct to the next normal, well-respected market observers find no shortage of things to worry about. 2, economic growth is being cut in half, but corporate earnings are expected to grow at double-digit rates. We would take the under. And 3, KBRA's head of ABS research sees stellar credit performance correcting, but gradually and in a highly manageable way, and ultimately that's good for the economy. As always, thanks for joining us. Don't forget to check in on KBRA.com for our latest rating reports and research, including Brian Ford's update on consumer ABS. See you next week.